Hello, class. This chapter deals with the adjusting process, and this is the third chapter in our course. And before I begin the lesson, I would like to emphasize that the adjusting process is one of the most important process in accounting. In order to calculate the net income correctly, we need to find out whether we have taken care of all the accruals and adjustments that are needed to include the revenue for a particular period and to be matched with the expenses of the same period. There are some expenses that need to be adjusted if we have prepaid something. Some of them would have expired, and whatever has been expired, that has to be accounted for as an expense if it is an asset, or if it is unearned revenue, it has to be transferred from the unearned revenue account to the revenue account. So that's why adjusting process is an important process which updates our books of accounts, and it is part of the accrual basis of accounting. Now, the learning objectives that we'll be taking in this chapter are: number one, describe the nature of the adjusting process. Number two would be to journalize the entries for accounts requiring adjustments, summarize the adjusting process, prepare an adjusted trial balance, describe and illustrate the use of vertical analysis in evaluating the company's performance and financial condition. So the first learning objective deals with the nature of adjusting process. Now, when we talk of nature of adjusting process, we need to understand the accounting period concept. The accounting period concept requires that revenues and expenses be reported in the proper period. So that means if you have earned certain revenue but you haven't received that money in cash, then you'll have to consider that as an accounts receivable and uh, compute the revenue for a particular accounting period. So that is, for example, I have provided some services to my clients, and I closed my books of accounts in December. Now, I haven't received any money from those clients. It doesn't mean I haven't earned that money because I have provided the services. So, if I have provided the services, I have already earned that service revenue. Therefore, it should be considered as a revenue for this particular period rather than the future period. So similarly, there will be some expenses like depreciation. I have used some assets and I need to charge that depreciation as an expense for the period in which I use that asset. So that's one concept that you need to understand. Next is the accrual basis of accounting. Now, accrual basis of accounting, according to this, it's one of the important generally accepted accounting principles that requires revenues to be reported on the income statement in the period in which they are earned. So that is the most important aspect. They are earned. Whether they have been received in cash or not is immaterial. We'll have to track whether we have earned that or not. And the accounting concept supporting the reporting of revenues when they are earned, regardless of when cash is received, is called the revenue recognition concept. So we talked about three concepts right now: accounting period concept, the accrual basis of accounting, and the revenue recognition concept. Now, another concept that we need to talk in the adjusting process is the matching concept or the matching principle. Now, the this matching principle or the concept supports reporting revenues and related expenses in the same period. So, in another words, supposing if I have earned the revenue this year but I haven't received cash, and when I receive cash in the future, if I consider that as a revenue for the future, that means you are violating the matching principle. So that's why it is very important that we need to match the revenues of the same year with the expenses of the same year. If you are doing a yearly statement. If you're doing a quarterly statement, it's very important that we match the revenues of the same quarter with the expenses of that particular quarter. So however, under the cash basis of accounting, revenues and expenses are reported on the income statement in the period in which cash is received or paid. However, you need to understand that the cash basis of accounting is not an acceptable basis of accounting for reporting purposes. So that's why it's important that we do learn the accrual basis of accounting. And under the accrual basis of accounting, some of the accounts need updating at the end of accounting period for various reasons. Some of the reasons are number one, some expenses are not recorded daily. Now, what we do is, supposing we record a utility expense only when we receive a utility bill from the provider. Same with the telephone. So that's why we need to update. Some revenues and expenses are incurred as time passes rather than as separate transaction. So that is like depreciation. We charge a depreciation only after a certain period of time has passed. Or if there is an unearned revenue, and it has remained in the books as unearned, but over the period of time you would have earned that revenue because of the passage of time. So we will have to consider that as a revenue. Sometimes expenses like prepaid expenses would be considered as an asset, but they would become an expense as the time passes. So that's why we need to update the books of accounts using the adjusting process. And at times, there could be some revenues and expenses which have not been recorded. Supposing if I have received a bill from utilities company, but I haven't made a record of that, then I need to bring that into our records because we owe that money to the utility company. So, therefore, the analysis and updating of accounts at the end of the period before the financial statements are prepared is called the adjusting process. So, in other words, the adjusting process involves updating the books of accounts at the end of the accounting period whenever we prepare the financial statement. So that is the adjusting process. And whatever journal entries we prepare, we will be calling those as adjusting journal entries. In the first two chapters, we talked about the general journal entries. General journal entries are not specifically for some particular purpose, but adjusting entries are to update the books of accounts. So therefore, we call them as adjusting entries. Now, the types of accounts requiring adjustments are first is prepaid expenses. Now, prepaid expenses are advance payment of future expenses and are recorded as asset when cash is paid. Like we usually pay our rent in advance. Now, when we pay rent in advance, it is not an expense until and unless I have occupied the property, and then it will be considered as an expense. So, first, for example, if I pay rent for January, February, and March, let's say $1,000 each month, so that would be 3,000 on 1st of January. 1,000 will become an expense at the end of January, 2,000 will become an expense at the end of February, or 3,000 will become an expense at the end of March. So whenever we are doing the accounting, supposing if I'm closing my books of accounts on 15th of January, that means only half of January's rent has been expensed. So therefore, I'll be considering only 500 as an expense. The remaining 2,500 will be considered as an asset because anything that we pay in advance. Similarly, let's say if I have purchased some supplies like water bottles. Let's say we purchased 24 bottles of water and each of them was costing $1 each. So $24 is the amount of expense on those water bottles that I purchased. Now they become an expense only when I consume the water bottles. okay, the water. They don't become an expense until and unless I have actually used them. So supposing I buy detergent for my laundry, so when I buy it, I'll be considering it as an supplies. But once I've used that detergent, then only it becomes a expense. So that is what you need to understand about these prepaid expenses. Now there is a format, chapter 3 CW01 on Blackboard. So please download that and we'll be working on it together. Now supposing, let's just take an example. Cash is paid in advance for an expense. So then that is considered as prepaid expense to cash. That would be the general journal entry that you will be doing. So when the payments are made for future expenses, they are recorded as an asset, and it will be debited to a prepaid expense account. So, and of course credit to the cash account as and when I have paid. Now at the end of the period, adjustment is required to update the prepaid expenses, because some part of that prepaid expenses must have expired. So the prepaid expense account needs to be decreased. Therefore, we are crediting it, and an expense account is created because we are just updating our prepaid expenses and taking it. Taking the money out of prepaid expense and transferring it to the expense account. So that is the adjustment for prepaid expense. Now there is a small exercise. We'll just take this up. Supposing your supplies account had a beginning balance of 1,975 and was debited for 4,125 for purchases made during the year. Journalize the adjusting entry required at the end of the year, assuming the amount of supplies on hand was 1,975. Now, uh, what you need to understand is, you need to understand that 1,975 was worth of supplies in the beginning. I purchased 4,125. So now the total supplies that I have is 6,100. So, but it says I have supplies in hand only worth 1,850. So it means the difference in the two amounts, 4,250, has been used. So therefore, I need to transfer that account, supplies account, to the supply expense account to the extent of 4,250. I repeat the concept again. The supply has account has a balance of 1,975 and I purchased 4,125. So if I add them up, I'll get a figure of 6,100. 6,100 is the total supplies available to me to use. And at the end of the period, I took a stock of the supplies and found that supplies at hand only worth 1,850. So what has happened to the difference in the two amounts? 6,100 minus 1,850 is 4,250. That is the amount of supplies that I have used. So therefore, I need to do this journal entry in the books of accounts to adjust the supplies account. So supplies account will be credited. Why? Because I have used up the supplies, therefore it is reduced. And because I have used the supplies, I have to open a supplies account, and it was zero right now. Now it is going up to 4,250. So expense has increased, so that's why I'm debiting it, and supplies is credited because I am reducing it. Next adjustment that we need to do is with regards to unearned revenues. Now, unearned revenues are advance receipts of future revenues and are recorded as liabilities when we receive the cash. Now, you may ask question, why are we recording this as a liability? Because if we do not perform the services for which we received that amount of money, we'll have to repay back. Supposing if I order something on Amazon.com and for let's say $500. Now, for Amazon, once they receive receive the money, that will be considered as their unearned revenue because they haven't fulfilled the order. Once they fulfill the order, then only it will be considered as a revenue. So if they do not fulfill the order, they'll have to return that money to me. So therefore, for them, it is going to be a liability. So that's what you need to understand. Whenever we receive the unearned revenues, we'll be crediting it and considering it as a liability. But once we have earned, then of course we'll have to transfer that money out of the unearned revenue account. So like in this case, you can see the journal entry that cash is being debited with the amount of money that I have received, and unearned revenue is credited. Now that is the journal that is done when we receive the cash, but at the end of the period, I'll have to do a journal entry like unearned revenue would be debit and revenue would be credit with the amount of revenue that I have earned. So that is with regards to unearned revenue. There is again, we are going to take a exercise 34A, page 131 of the textbook. The problem states the balance in the unearned fees account before adjustment at the end of the year is 78,500. Now, before adjustment means before the end of the period, the amount was 78,500. Journalize the adjusting entry required, assuming the amount of unearned fees at the end of the year is 33,675. Now, before adjustment, it is 78,500. Now, if it is 78,500 and now it is only 33,675, so what has happened with the difference? Now you need to understand the difference has been earned. So what is the earned amount? 44,825. That is 78,500 minus 33,650. So that's how we'll be handling that. As you can see, unearned fees is debited and fees earned is credited with the amount of earned fees. As you can see, 78,500 was the unearned fees balance before adjustment, and at the end of the year it is now only 33,675. So the remaining balance has been earned, that is 44,825. Next is accrued revenues. Now accrued revenues, as soon as you see that word accrued, it means cash has not been received or paid. Accrued is a kind of a credit transaction. Accrued revenues are unrecorded revenues that have been earned for which cash is yet to be received. So, whenever you have earned the revenue but not received in cash, then we'll have to create a accounts receivable account. Of course, when the revenue has been earned but has not been recorded, of course, we'll not be making any entry. But when we are doing the adjustment, we'll be doing entry where we'll be debiting the accounts receivable. An asset account is created because I have to receive that money. So in future, I'll be receiving that money, and that is why we'll be debiting the receivable account and crediting the revenue account. And now the accounts receivable, interest receivable, dividend receivable, whatever is the revenue that has been earned and accrued, that is the account that we'll be using. Now, for example, supposing we have an exercise 35A on page 131, it says at the end of the current year, 12,840 of fees have been earned but not been billed to clients. Journalize the entry to record the accrued fees. So I have earned those 12,840, so therefore fees earned would be credited, and I will be debiting to accounts receivable because I haven't received them, because I have not billed to the clients. So unless I bill them, they won't be paying me the money. So if I receive the money instead of accounts receivable, I would be doing cash. But in this case, I haven't received, so therefore I'll be using accounts receivable. The next type of account needing adjustment is accrued expenses. Again, accrued expenses, as soon as you see the word accrued, it means that you have not paid those expenses. You have incurred them but not paid. So, Whenever expenses have been incurred but has not been recorded, of course there will be no record. That's why it hasn't been recorded. But when we bring it to the record using the adjusting journal entry, then we'll be debiting the expense account and crediting the expense payable account. That's a liability account. So that's how we'll be adjusting the accrued expenses. The example in the book, page 3131, 36A, is Connect Realty pays weekly salaries of 16,250 on Friday for a 5-day work week ending that day. Journalize the necessary entry at the end of accounting period, assuming the period ends on Wednesday. So normally we pay on a weekly basis, but this time our um, accounting period is ending on on Wednesday. Now, when it is ending on Wednesday, I would have to pay for 3 days. That will be Monday, Tuesday, and Wednesday this year. Whatever is paid on Friday would not be for this next year alone. It would be for this year as well. So that is why what we'll do is we'll adjust the 3 days one. So if every day the total 5-day week salary is 16,250, and then it's a 5 days week. So what we do is we divide and find out what is the amount of daily rate. Now daily rate, whatever is 16,255 250 divided by 5 will give you a daily rate of 325. So 3,250, and then times 3 would be 9,750. So that's how we'll be doing that journal entry whenever there is accrued expenses. Okay, now next learning objective that we'll be taking up is the entries for requiring adjustment. We'll just take some examples and then we'll do a problem. So this is the unadjusted trial balance we have prepared in the previous chapter. So now what we need to do is we need to do the adjustments, and as you can see, all those red accounts are those that are added because of the adjusting process. So you'll have to update your chart of accounts accordingly. So now first issue is Net Solutions supplies account has a balance of 2,000 on the unadjusted trial balance. Some of these supplies have been used. On December 31st, account reveals that the amount of supplies on hand is 760. So the difference between 2,000 and 760, 1,240 is the amount of supplies we have used. So we need to do a journal entry like supply expense to supplies account 1,240. Now, of course, as you can understand, supplies is an asset. I want to reduce that asset to 760. Therefore, I would be crediting it. And expense is, of course, a reduction in the owner's equity. And when you want to increase that, of course, you'll have to debit it. So that's why expense account is debit and supply is credit because it is decreasing. The debit balance of 2,400 in Net Solutions prepaid insurance account represents the December 1 prepayment of insurance for 12 months. So if it is for 12 months, 2,400, then for a month it will be 200, and that will be insurance expense to prepaid insurance. Now, prepaid insurance is an asset account. I want to reduce it, so therefore I will be crediting it, and insurance expense is an expense account. I want to increase it because I'm transferring money from prepaid insurance and putting it in the insurance expense. So that would be a debit to the insurance expense. The unearned revenue example, the credit balance of 360 in Net Solutions unearned rent account represents the receipt of 3 months rent on December 1st for December, January, and February. At the end of December, 1 month's rent has been earned. So therefore, I'll have to transfer 120 out of the unearned revenue account, unearned rent account to the rent revenue account. So that's what I'm doing. Unearned rent account is being debited because I want to reduce that amount from 360 to 240 because 120 has been earned, and of course revenue has been earned, therefore it should be credited to that. So unearned rent is being decreased and revenue is being increased. Next example is the accrued revenues. Net Solutions signed an agreement with Danker Company on December 15 to provide services at a rate of 20 per hour. As of December 31st, Net Solutions had provided 25 hours of service. The revenue will be billed on January 15th. So now what has happened is we have signed an agreement with another company on December 15 to provide services at the rate of 20 per hour. As of December 31st, NetSolution has provided 25 hours, so that means I have earned that 25 hours of service revenue. So, although I have not received in cash because I'll be receiving that only in January, I'll be billing it only on January 15, and after that I'll be receiving. But at the end of December, I need to consider that 25 times 20 will be $500 as revenue earned. And since I have not received in cash, I will be considering that as accounts receivable and debiting it. So accounts receivable is increasing, therefore I'm debiting it, and revenue is also increasing. That's why I'm crediting it, because they follow different rules of debit and credit. Now, next example is the accrued wages account. Accrued wages account, of course, Net Solutions pays its employees bi-weekly. During December, Net Solutions paid wages of 950 on December 13 and 1,200 on December 27. As of December 31st, Net Solutions owes 250 of wages to employees for Monday and Tuesday, that being December 30 and 31st. So therefore, I need to make that as accrued wages. So that's a wages payable account of 250, and I would have to recognize that 250 as an expense. Expense is increasing, therefore I'm debiting it, and the liability is also increasing, therefore I am crediting it. Now of course they follow the opposite rules of debit and credit. Now next thing that we haven't taken so far is depreciation expense. Fixed assets are any physical resources that are owned by the company and used for the by a business and are permanent or have a long-term life. They are known as fixed assets or plant property and equipment. So that will be the different names that you will be using. As the time passes, a plant property equipment or fixed asset loses its ability to provide useful service. Like supposing, for example, if I purchase a computer and if it is supposed to give a life of 3 years, then whatever is the cost of computer, I'll have to transfer the one third of the cost of computer as an depreciation expense each of the years. So that is the example of depreciation expense. Now, of course, all assets except land will lose their usefulness, thus, they are said to have depreciated. Now, there are different words meaning different things. Amortization is basically used for intangible assets and without any physical form, like copyright. If you lose its value, then that's amortization. A goodwill is also amortization. Sometimes we technological asset we call it as obsolescence, so that's same as depreciation. They become obsolete because a new technology has come into the market and the old technology just goes out of practice. As however, normally property, plant, and equipments we call them as we depreciate them. That is the word that we'll be using for these tangible assets. A portion of the cost of that particular asset will have to be recorded as an expense, and this periodic expense is called an depreciation expense. Now, please understand the depreciation expense is just a book entry made in the books of accounts. We don't need to pay that money. Whatever money we have paid, we would have already paid when we purchased the asset. But for depreciation expense, we don't need to pay anything. We are just making a book entry. Now, usually um, the normal practice could have been to credit the fixed asset account while making the relating adjusting entry for expenses, but sometimes not. Sometimes, usually what we want to do is we want to know what was the original cost of the fixed asset, and whatever depreciation is recorded for its use, we want to have them into separate accounts. Therefore, we open a separate account known as accumulated depreciation account. It is a contra account. Why it's a contra account is because it reduces the value of the asset. So that is why we call it as a contra asset account. Normal titles for fixed asset accounts and their related contra asset accounts are as follows: a land account, it's not depreciated, so none. Buildings account, it is accumulated depreciation buildings. Store equipment, it is accumulated depreciation store equipment. Office equipment, accumulated depreciation in office equipment. Now, depreciation expense example is Net Solutions estimates the depreciation on its office equipment to be $50 for the month of December. So this is the journal entry that we do, depreciation expense. So every time depreciation is charged, depreciation expense is debit and accumulated depreciation is credit. So that's how we would be doing the depreciation account. Now depreciation expense increases and contra asset increases, so therefore we debit and credit. Now, there is another concept that you need to know about the book value. Now, the difference between the original cost of the equipment and the balance in the accumulated depreciation account is called as the book value or the net book value of an asset. For example, book value of an asset is equal to cost of the asset minus accumulated depreciation. Book value of office equipment will be cost of office equipment minus accumulated depreciation. For example, book value of office equipment in our case would be 1,800 minus $50 will be 1,750. So 1,750 will be considered as a book value. Now please go ahead and download chapter 3 classwork number 2 from Blackboard, and we'll be doing that problem with you.